Jim here. Today I want to share with you one of the great ways to make passive income, and that's selling put options. If you're an investor and you want to buy a stock, why not sell a put option? You can actually make some extra income before even owning the stock. So today I want to share with you how to do that, how to get started, and why it's fairly easy to do. So stay tuned. I think you're going to enjoy what I have for you today. Now, before I jump into details about selling puts, I do want to kind of give a quick market update. I like to do this in most of my videos. I believe I didn't do it last week. Primarily what I want to mention is the media is still really trying to scare people. It seems like even YouTubers are talking about, Schwab going out of business and all sorts of crazy negative things. I do think that's a little bit overkill. I believe that we are probably at a turning point. I believe the market's still going to kind of go sideways, but the VIX is down, the amount of volatility in the market is down. The move index is also down, meaning the chance of bonds, the rates on bonds going up quite a bit is kind of down. So we're probably not going to have as big a move in rates as we think. And I think that reflects in the Fed. I personally don't think they're going to increase another quarter point. A lot of people do think they will increase one more quarter point, but I think the consensus is once they do maybe one more increase, they'll be done, and there's a possibility, a very strong possibility, that they may lower rates later in the year. So that brings me to my other big point is a lot of people are jumping into treasuries. They're like, oh wow, we can get really good interest rates on treasuries, on I bonds and things like that. Now understand that just as quickly as those rates went up, they can come down. I don't think they'll go back down to the levels they were before the Fed started raising rates. But I wouldn't be surprised if they're back in the 2.5 to 3.5 range. I believe I bonds have been readjusted again, and I think they're around 3.5 to 3/4 versus 6.5 to 6/4. So don't expect those rates for long term. If you're really considering moving a lot of money into treasuries, just be careful because again they're variable and they can come down as quickly as they've gone up. And then I also think the market's going to continue going sideways. And once we know for sure what the Fed's going to do, it could turn us into a bull market. If the Fed decides they're not going to raise anymore, or if they come out and say they're going to lower rates, we're going to jump into a bull market. And it's important to remember that if you're out of the market once we switch from a bear to a bull, you're going to miss a lot of the gains. A lot of the gains are in the first 6 months to a year of a bull market. And if you're out of the market, you miss a potentially huge upwards trend. So let's jump into the main part of the video. So I've been doing cash secured puts for probably, I guess, 2.5 to 3 years. In the beginning of my journey, I first started with covered calls, and to me, they seem like the safest type of option strategy that you could do. But it's really kind of different for each individual. If you've never done covered calls and you don't have a portfolio, then really cash secured puts or vertical put credit spreads may also be a very safe strategy. Now I typically start with a cash secured put, and then if I can turn it into a vertical cash or vertical put credit spread, then I do. I primarily look for an inexpensive put to purchase, but I'll go into more about that later. But the key point is to understand that cash secured puts and covered calls are the two most safe strategies, I believe, and they are the key points of the wheel strategy. So that's again where the wheel strategy comes from. Now, before you actually start trading in puts or calls, you really need to pick good companies to own or companies you want to own. I like to build a portfolio. I'm also a dividend investor. I like income. I like the income that comes from my portfolio. I can live off quite a bit of the dividends that come out. I believe I'm close to $2,000 a month in dividends. So my goal isn't just to be earning premium selling puts and calls. It's also to be earning good dividends and adding securities to my accounts that pay good dividends, and then also increasing those dividends. So before you start with anything, you need to kind of pick some good quality companies or ETFs. And these are companies that are showing good growth. Their financials are good. They have little to no debt or very small amount of debt. And again, that they're increasing dividends. The fact that they can increase dividends is a good thing. And also look farther into the future. There's a lot of companies that are struggling due to these higher rates. When the rates do come down, maybe a point or 2 points, which ones are going to do really well. So don't just look at the current situation, but look into the future and try to figure out which companies work best. And then also, I also like to invest in companies I understand, that I have, it's not like rocket science to me. It's stuff that I can easily understand. And that's really what Warren Buffett does. He's primarily invested in companies he understands. And then you need to have enough cash to cover these shares. And typically, in order to sell calls or puts, each contract is 100 shares. So you need to have enough money for those 100 shares. So if you're doing a $50 stock, you're going to need $5,000. And I even do that when I do vertical put credit spreads. I still want enough money to cover that, the short or the put contract that I'm selling. So that's one of the key steps. Let's kind of backtrack a little bit. Even before that, if you've never sold options and you do have a brokerage, it's relatively easy to get started. You can call your brokerage and you can ask them to give you the basics for trading options. With Schwab, there's like different levels. There's a zero level, which I think you can do covered calls and cash secured puts. Then there's a level one, which I think they add in some margin stuff so you can do vertical put credit spreads. And then I believe there's a level two for really more complex strategies, probably things like iron condors. These are strategies that are a little bit more complex. So you can actually call them and they can handle it for you at Schwab. That's what I did originally. And then when I did that originally, I just did it with one brokerage. And then 2 years ago, I decided to turn it on for all my different accounts. I'm trading in my IRAs, in my Roth accounts, in my SEP account, even that I have related to my company that I'm currently running. It's my S Corp. So again, it's relatively easy to get started. And if you're confused or not quite sure, just give your brokerage a call and they can kind of show you what you need to do. Now, once you have enough cash to buy some shares, you could sell a put. And you may ask, well, what is a put? A put is where you're giving someone the opportunity to sell you those shares for a certain amount of money. So if, say, it's a $50 stock, you're selling a put contract, where someone can sell you those shares and they're going to pay you some money to actually, when they buy that contract. So you actually earn some income or premium. And you might say, well, why are they doing that? Now, if a lot of investors, if they own a lot of stock, like I have a fair amount of Coca-Cola because I inherited it when I was 16, I could actually sell puts to protect me on the downside. So you get a lot of people who are doing it mainly to kind of hedge their bets and protect their portfolio from a huge loss. So once you sell that contract, and again, let's use the example I like to use. So I'll say a $50 stock. It could be something like Cisco. I believe Cisco's under 50, but let's just use 50 as to make the example a little bit easier. So I would do what's called a 15 delta, and it usually reflects in about a 10% discount. So I would look at selling a put at $45, which again is 10% below the $50 current stock price. So I would pick a strike around 45, and that corresponds to what we call in the industry delta, and it's one of the Greeks. And there are other videos related to the Greeks. But long story short, it just tells you what's the probability that that option contract will be called away or will be assigned. So a 15% chance is that you've got about a 15% chance that it would be assigned to you. Now, I'm taking less risk, and the reason I'm picking a 15 delta is being in the bear market. I'm taking a little bit less risk. If I wanted to take more risk, I could do a higher delta. And again, it just relates to the price. So instead of selling a strike at 45, I may do a strike at 47, and the likelihood of being assigned is a lot higher. I also will look at expiration, so I'll look at anywhere from 30 to 90. Sometimes I'll go out as far as 6 months, and I've gotten a lot of questions. Well, why do you go so far out? Why don't you do shorter spreads? Well, I trade in a very passive way. I try to do one trade a day potentially and earn around $200 on that trade or close to 200. So I go farther out primarily to get to that $100 a contract. So I want to earn about $100 a contract, and sometimes enable to earn that amount, I have to go a little bit farther out. So a lot of my trades may be 60 or 90 days, and I'll show a trade at the end of this where I believe I went out 60 days to 90 days. So I'll go a little further out to bring in more premium, and it also allows me to pick a lower strike price. So, if you're going a week out or a month out, a 15 delta may be like a $48 strike, whereas if you go 60 to 90 days out, well, it may be a $44, $45 strike. So the farther you go out, the less risk, because you can pick a much lower strike, and sometimes you can earn more money. Now, you could potentially do better, and there's been a lot of controversy about this. Doing one weekly contract, you may be able to do 8 or 10 trades in the time frame you do that one, and that's can be true, but you are definitely taking more risk doing a shorter um, time frame, or a shorter expiration, meaning fewer DTEs, or dates to expiration, or days to expiration. Uh, so again, it's your preference. I prefer to do it this way. It's worked for me. I do make adjustments sometimes if it doesn't go well and too much is assigned to me. I haven't had much assigned recently. I think I had some truest assigned to me recently related to the bank situation. But before that, I hadn't had anything assigned since last October. During October was when the market hit its low, and I did have several shares assigned to me. So that's primarily why I do the longer expirations. And also, with the volatility down, it's harder to get enough premium to make it worth my while. Um, so that's primarily why I like to go a little farther out. So next, you know, I found that some of the time I do miss opportunities. So there may be stocks. Let me just give one example, Devon, and again, that'll be the example that I provide at the end of this. I don't own it yet. I've sold lots and lots of contracts on it. It's currently right around 50. So there's times that I think, well, maybe I should take more risk, and I may take more risk because I really do want to own it, and it does pay a good dividend. So in some ways, I may be, not taking enough risk. And I do have people in my memberships that are taking more risks and potentially are doing better than me. Again, it's up to you and what works for you. But if you're starting out, I would take less risk, and I would, also start with like one contract, learn the basics, learn the terminology, because does take a little while to get used to kind of the odd terminology, open to close, close to open. So there's lots of terminology, and things that you need to learn. You need to learn about the great Greeks and, Delta. But overall, you can get started. You can do it fairly easily. Again, if you know a stock you want to own and it's optional, meaning you can actually sell options against it, then I would give it a try. I would pick something, again, that you really want to own, and I would pick a price you want to own it, and then I would sell, a contract on it, and just watch how the whole process works. Nothing teaches you better than doing. So I encourage people, to jump in and give it a try. There are a lot of people that'll do paper trading. That's another way of doing it. I believe Interactive Brokers and TD Ameritrade have the ability where you can set up your account to actually play trade for a while. But until you really do it and you really, put money at risk, you really don't learn the details about it. You'll learn a lot more when you actually jump in and put some money at risk. So, and then typically, if you do get assigned, and assignment, it just means someone, your strike price becomes in the money, meaning if if during expiration your strike price is in the money, then that person can actually put you those shares. And during expiration, if you're in the money, you will be assigned at expiration. Now, most trades do get assigned to you at expiration, but it will occur before expiration. But a majority of the trades, it's literally right around expiration. And this is especially true of puts. Now, the only exceptions I've run into is scenarios when the market is really going through some turmoil, like last October. People got margin calls and they had to get the cash, so they did put the shares to you or to me, mainly because they needed the cash to deal with their margin calls and other issues they might be dealing with at that time. Um, but again, if you start out and you want to own the stock, and you, just by the nature of put options, you'll be getting it at a better price than if you had bought that stock originally when you had thought about it, because you instead of picking that price, you picked a price that was 10% lower. Plus, you got paid to do it. So really, you've done better than just buying the stock. Um, Next, I do want to mention one thing I didn't understand for the longest time was that you could actually manage these trades. So I manage all my trades about 3 weeks out, and I have what I call my planning worksheet that I also provide to my membership. Um, and in that planning worksheet, I put all the different stocks that may be expiring over the coming weeks. I even will put ones that are deep in the money so that I can manage them. Because at first I didn't realize you could roll it, and rolling is just closing your current position and opening a new one, and hopefully bringing in enough premium in your new one to pay for the, what you have to pay to close the current one. Or you can simply close it once it becomes profitable enough, and I do that a lot too. I believe I just today closed an Apple trade, because it was very profitable. I think I was able to close it for like $14 or something. And then if you're way out of the money, then you just can let it expire. And so when expiration day comes and goes, you end up keeping all the premiums. So in some ways, that's the easiest thing to do. And for the longest time, when I was just selling covered calls, that's all I did. And then again with assignment, if you look at it and you're picking stocks and ETFs that you really want to own, then assignment really isn't a bad thing, it's a good thing. And it's important for people to keep that in mind, because sometimes I think some people are trying to avoid assignment so radically or so much that they get themselves into deeper trouble. Sometimes it's just best to let it get assigned to you. Again, especially if you picked it at a price that you're really happy to own it at. So that's the main stuff I wanted to share related to puts. I do want to jump into the next part of the video where I'm actually going to show you an example and what it looks like when you're actually trading, kind of a real-time example. So stay tuned. Let's jump into the next part of the video. Okay, I've logged into my Schwab account and I've opened up Devon Energy, which is the company I kind of want to talk about today with selling cash secured puts. But before I go into details, I do want to mention, please subscribe, hit that like button. If you're curious about my memberships, you can take a look below. I have two membership levels. I have a kind of the basic level that includes my trades as well as all my spreadsheets, and then some additional content that I like to post. And then the more expensive one, which is $25 a month, it also includes direct access to me through Zoom meetings once a week. I mention 15 minutes, but it always goes over 15 minutes. So, and that's talking directly with me. So, again, if you're interested, take a look below. Now, Devon Energy is one of my favorite companies for selling cash secured puts on. And again, I always start with a cash secured put. And if I can buy the farther out put, then I would or will, and will turn it into what I call vertical put credit spread. But Devon is a good company. Let's jump into details about it. So it's down quite a bit today. Again, if you're selling puts, it's typically good to sell puts on a down day for the stock as well as for the market. So even if the market's up but the stock is down, it's probably a good day for puts. And the reverse is true with calls. If the market's up and the stock's up, then again you can good day for selling calls. Typically the premiums for the calls will be up. So just keep that in mind. So if it's an up day in the market's doing really well, you should be looking at calls. If the market's down, and like today, you can see it's not down majorly, but it is down. It's a good day for selling puts. So again, Devon Energy, good day for selling puts. You can see it's not at its all-time low, but it's closer to the low than the high, and that's typically what I like to see. And this line is the moving average, so it's right at its. I think that might be its 200-day moving average. Um, yeah, I believe that's its 200. No, it's probably its 50-day moving average. If you look at it, I believe it's around 53. Yeah, it looks like it's right around 53. And then you can see it's got good earnings. It did slightly miss earnings recently, but it's got a real low PE. Price to earnings is like 6. Every other quarter, it's actually beaten earnings. And then dividends, it does variable based dividends. So right now it's only 9%, but it can be even higher or it could be lower, but typically it pays really good dividends. So it's a good stock to have in your dividend portfolio. And again, one thing I do like to look at is I want to pick it up closer to the 52-week low. And if I can get a 10% discount, which would be putting this in the mid 40s, mid to high 40s, so that would be 530 off. So you're talking like 47, 48, just by eyeballing, where the 52-week range is and also where I want to own it at. So now I can actually jump into the option chain, and you can see here I've got it set to Greeks. Custom, I typically like to do, I believe August 18th. Yeah, so this is 60 to 90. No, 30 to 90 days. So that's why I have that. And then for custom, I've got it between 35 and 50 so that I have the pricing and the strikes around the range I want to see it. So here, 29 days. And again, I like to get a 17 delta so you can see there's a huge jump between 50 and 45. So in 23 delta, I could potentially look at 50, but I still want to go lower because I want to play it safer. So now if I look at 36 days, and some of these it's probably not worth it. I like to typically jump out to what's called monthly options. There's a lot of weekly options, but the third Friday of every month is what's called a monthly option. So I like to jump out to those particular days because they typically have more activity and you can find more premium typically, not always. So here you can see again a big jump, mainly because the strike is a $5 difference, 50 versus 45. And you can see a 29 delta versus a 13 delta, but even the 13 delta is paying some pretty good premium, $71. And then the put I could purchase at 35 is pretty cheap, between 7 and 17. So I could potentially pick up, let's just say it's the high of both of these, you're talking $60. So again, I'm typically trying to get $100 per contract, so that would not be enough money for me to make this trade. So I'll go out a little farther. So here we have 92 days. So now you see we've got 45 strike, which is a 17 delta. And again, you never get the exact delta you want. It's very rare to get a 15 delta. Now for SPY and IWM, which is the S&P 500 and the Russell 2000 ETFs, you have a lot more strikes, you have a lot more expirations, and you can get really close to an exact delta that you want. But in cases like Devon Energy and lots of other stocks, it can be very difficult. So 17 delta is as close to a 15 delta, and an 8 delta here would be too low for me. So here you're talking between 120 and 123, and then a 35 strike between 21 and 29. So that's really close to, um, that's like a 90, 92, $93 per contract. So this is what I'd be looking at. So typically I would do select, and then I would come back up, and then I would do continue. Okay, and so here you're seeing this is a cash secured put. I could say sell to open, and this is where I was talking about the terminology can get kind of confusing. That's why I say stick to one contract initially, just so you get used to it. You might even want to do that for a couple months. That's what I did when I started my journey. I would primarily just do one contract, and there were times I did stupid stuff. I literally put in the trade backwards and freaked out and ended up calling Schwab, and they showed me how you could just re-enter the same trade in the reverse. And I think I took a $3 loss, so it wasn't a big deal. Looks like the market just dropped quite a bit. It's down 145 now, so it looks like towards the close it's dropping a bit. So here I could do sell to open, so, and it's the bid, mid, and ask. So typically you're going to get it somewhere in between these. Now, if I did this trade the way it is currently, it would put it in at $1.23. So, and that's what I used to do. I used to do these limit trades, and I would not get assigned a lot. I'd have to keep re-entering it and re-entering it. So I typically will do a market trade. So here it's showing for one contract $120, which again is better. It's what I look for. So I try to get per contract. So typically I would do two contracts and make closer to $240 for this trade. So if I switch this to two, you'll see it adjusts it. So now it's $240. So here it's saying this is a cash secured put, and just because it's just one row here, you can tell it's a cash secured put. If it's a vertical put credit spread, it would have two rows. Um, so here I could scroll down and say review order and place order. Um, but what I'm going to do is I'm actually going to change it to a vertical put. So here now you see the two rows. So this is what I was talking about before. So I was looking at around 45. I could say sell to open at 45 and then buy to open. So turning this into a vertical put credit spread with a $10 spread, I'd bring in $91 one contract. And again, this is where I would start if I was just starting from the beginning, and I would change this to market, and it would be $91. And so I could literally make $91 by doing this trade. So if I come down and I say review order, and you can see what it does is it shows you what the fees are, and you can back out of it or change the trade if you wanted to. I typically would do two, so this would bring in closer to $180. Again, I'm shooting for 200 for each trade, but a lot of times the trades are 160, 170. Then I'll have another trade that's 220, 230. So it balances out. So I actually rolled, and I think I made close to this. I didn't make quite as much, but this is definitely a trade I would look at making. And the reason it's called a vertical put credit spread is because again, you're selling the 45 and opening it. So if you got assigned, you would be assigned at the 45, and then you're buying to open the 35. So here you're spending, between 21 and $29. It's coming up with the 91. So it's picking the bid for the one you're selling and the ask for the one that you're buying, and then it's showing you the fees. So it works out now nice. And what happens is at this point, I can actually initiate the trade. And I'm not going to do it since I already did one of these trades earlier today. I actually rolled an existing one. But Schwab will try to do better. So in a sense, if they can get closer to the 122, they will. Or for the option you're purchasing, if they can get closer to the 21, they'll try. And I probably have seen maybe 50% of my trades, that's what's happened. So So this is it. This is the kind of steps I would take. And again, I do this very part time, very passive. So I'll get on. I'll find one of these trades. I'll look for stocks. So I've got what I call is my watch list, and you'll see here. You can sort them. You can see who's doing well, who's not doing well. You can see Tesla's way down to down 10%. Um, so Tesla would be another one, but I'm playing with the idea of doing a Tesla trade, but currently I don't want to. And you can actually do any number of watch lists. I have a number of different ones, like a low price watch list, a growth. And I also do share these with my memberships. I do need to put these out again, um, but this really helps me too. And then you can also see the 52-week low, so you can see definitely if Tesla gets down to close to 101 again, I'll really consider selling some puts on it. Zoom is another one I like. Cisco is probably one of my favorites. It had some negative press come out, so it's down. I actually looked at trying to make some trades with Cisco, and there wasn't enough premium for some reason, at least earlier today. In Zoom, I currently I think have two trades, and I currently well, do I own any Zoom? I don't own any Zoom yet. And what I like about Zoom is it has no debt, and it's making some pretty good income. There are some weird things going on. I think they let their CEO go, but between I typically will jump into this watch list on a down day, see who I can pick up at a good price, and if it's an up day, I'll do the same thing. I'll see, I'll look at my stocks and see, you know, who's doing well and who's not, and make some decisions that way. But again, I do this very passive. I try to do one trade a day if I can, and again, try to do it around $200, and I do two contracts. I have stuck to that. It's worked for me. Again, when I started, I did one contract, and I encourage you possibly, or probably better for you to start with one contract, especially when you're learning how to do it. Some people will do 5, 10, 20 contracts, may do shorter or smaller spreads. I find that more risky. This works for me. I'm making small tweaks to improve on the process. So that's it. That's what I do. It hopefully it doesn't look difficult. It really isn't. Once you've done it a couple times, it becomes second nature, and it's a great way to pull in extra passive income. So, thanks for joining me. I hope you have a wonderful day.